Welcome to the Smart Mortgage Show with Bill Litton.
Welcome into the Smart Mortgage Show. Glad to have you with us today. We got a good show for you. We're going to get a market update, the debt ceiling, what impact it's having on rates. We'll have Bill break that down for us. Also, questions that your lender should be asking you. If you've been in a meeting with your lender, or if you've spoken to some mortgage lenders and you haven't been asked these questions, we want to make sure that you are bringing these things up in your conversation. And then also we'll close out with a good question that came across recently about how much money you need to put down. As rates rise, people are wondering how little can they put down and still get a mortgage and feel comfortable with that. So we'll address that all on today's show. We need to welcome in Bill Litton. Bill, how are you?
Hey, Ben. Doing good. Yeah, it's been quite a ride in the mortgage industry over the past 6 months. So we're, I think, moving into some greener pastures as an industry because things slowed down. And just up in the, Delaware County, Chester County, Pennsylvania area, Newcastle County, Delaware, things are starting to pick up for sure, which is good. We're not back to normal levels, but we're kind of swinging in that direction, which is a good thing.
Yeah, glad to hear that. And if you don't know, Bill is a regional president at Cross Country Mortgage. You can always find everything online at smartmortgageshow.com, or you can call 484-352-4151.
It's time for the market update.
Bill, let's get into a market update here for June. I know the biggest thing a lot of people have talked about, not just in your industry, but across the board with the economy and anything dealing with financial impacts, is the debt ceiling. And we've kind of been watching this. And hopefully when someone is watching this episode, the debt ceiling issue's been managed and they've come to an agreement in terms and the bill has been passed. But I know over the last few months, this has been a big topic of conversation. It's had a big impact on the mortgage industry. So kind of bring us up to speed on what this has meant for rates and kind of what you're watching.
Yeah. This is a really important topic right now in our industry because as the rates started to rise late in 2021, the reason was mainly inflationary. So now that we see signs that inflation is under control overall, which is probably like the larger chronic issue for rates, there's now this really acute issue that we're dealing with. And that issue is the debt ceiling. The debt ceiling means that if we raise the debt ceiling and we appropriate funds for the U.S. government to pay their bills, and I think everybody knows that much. I think where it has an effect on mortgage rates is our U.S. government issues bonds, children for years for birthdays and communions and all kinds of life events would get like a U.S. savings bond. And that's you lending money to the government with the idea that they're going to pay you back. Mortgage notes are bonds that are backed by Fannie Mae and Freddie Mac. They're quasi-government agencies. So people who purchase these bonds have been a little gun shy because they're saying, I'm not going to buy the bond if you don't have the money to give us payment back for the money that we lent you. If the debt ceiling does not increase, technically those bonds could be in default. Now, we know that's probably not going to be the case. The U.S. government has never defaulted on debt. We have a AAA bond rating. But when these issues come about and we're close to a deadline like this and we do not have a clear-cut solution in place, the market gets jittery and people sell off these bonds. When they sell off the bonds, the rates go up.
Okay. So it's been some treacherous waters, I think, for a lot of people and something that everybody's keeping an eye on. So do you think once this is kind of in the rear view now, hopefully in the next couple of weeks, and things might start to settle down again some?
So, Ben, by the time this show comes out, I hope you're right that we have come to an agreement on both sides. And that is the hope as this thing moves through Congress, which it made an important step yesterday, which moves us closer to an agreement. But if for some reason we don't make an agreement, it could cause some resounding effect. And rates, right now, rates are roughly 7%. I wouldn't be surprised if rates jump to 8% if we don't get this debt ceiling increase approved. Now, if rates go to 8%, they are going to get this debt ceiling issue remedied. And then what we believe is that rates would come down pretty quickly. So again, this is more of an acute issue, but if you're buying a house right now, it's definitely a concern. You're feeling the impact of those higher rates.
Yeah, I don't know. I think I saw that maybe a headline that the mortgage industry is maybe seeing less interest here in the last month or so than it has in a while. So hopefully that all turns around. But something to definitely keep watching. And I guess if it do hit 8, when's the last time we hit 8% on the mortgage? Did we ever hit that over the course of the last year?
We never got to 8. We got to about 7.5% for about 30 days. And so I got into the mortgage industry. My first day was May 1st, 2002. Rates just hit 6%. And at that time, 6% was like the most amazing rate that anybody had ever seen. So I personally haven't seen 8% on a 30-year fixed. I do believe late 90s would have been. So you're talking 25 years ago since we've seen a rate that high. Wow.
Well, if you have questions for Bill, want to follow up with him again, always find us online at smartmortgageshow.com, or you can call 484-352-4151. Now I want to get into our main discussion today, Bill, with you, and that's on questions that your lender needs to ask you. Because I think when we go into a meeting with a mortgage lender, if you are going in to buy a home and you're getting into this process and you're starting, you just kind of assume, hey, the lender knows all, right? The lender's got a list of questions they should ask me, but that's not always the case, right?
So, what we find in mortgage lending is that a lot of times people are just advertising the lowest interest rate. Okay. And when they do that, they're really almost negating all the other important things that are very valuable when you're trying to get a mortgage, things that you really need to, very valuable considerations, right? So people are fixated on rate. So if somebody just advertises, doesn't even mean you're getting that rate, just advertises this really low interest rate, that could get you to call them. And then if the rate's close or you feel like, you might be getting a good interest rate, it almost negates thinking about all these other really important considerations. So our approach is certainly a holistic financial view. We're going to offer you a very competitive rate, but we're also going to make sure that we're looking at all of the important parts of what it means to get a mortgage. So lenders should be asking specific questions to learn about your whole, your situation as a whole.
Okay, perfect. So these questions that we're going to provide you with today are, ones if your lender's not asking you, maybe it's a bit of a red flag, or if nothing else, you want to kind of bring this up and start that discussion. But hopefully your mortgage lender is asking you these questions. So first one, Bill, what's the first question that your lender should be asking?
So your lender should be asking, what is the maximum payment that you're comfortable with? Okay. So, and that payment is principal, interest, taxes, and insurance. Okay. So we want to make sure that from the very beginning, we're targeting the correct payment range based on purchase price and real estate taxes. And if there's an HOA or a condo fee, that's part of your housing payment. So we want to make sure that that payment is in line. And then the next question is, have you put that payment into your budget? Maybe the payment's more than what you're paying now. Maybe you think it works, but you haven't actually plugged it into your budget. And we find that it's really important to understand how that payment's going to affect your ability to buy groceries or go on vacation or do some of the fun things. We don't believe you should be married to your house, right? Mm-hmm. You don't want to be house poor. And we want to make sure that we're putting you into a position where that doesn't happen.
So you can basically get like three different answers. Like what can I get qualified for? What am I comfortable with? And then what actually fits into my budget, right? Those could be three different numbers completely.
As we saw in 2008, the lender might approve you way up here, but really that's not in your budget, right? That's going to restrain your lifestyle. And that might put some people under that could put somebody into foreclosure. A lender, a lot of times they'll pre-approve you much higher than they should. So there's, well, what does the lender say you can afford? But what's most likely going to allow you to continue to live the lifestyle you're living? That number might be down here. Mm-hmm. That's what we want to hone in on.
Yeah, because I feel like you just mentioned, anytime you go in and say, okay, what am I qualified for? I feel like whenever I've done that personally, that number is always higher than I expected. And I think that's just because of how the formula works out to what you can actually be approved for. But that doesn't necessarily mean that that's what you should be spending every month on your mortgage.
That's exactly right. And by the way, we get a lot of people who say, hey, can you just pre-approve me for the absolute maximum? That might be a really bad recipe, especially because maybe the maximum is an exotic type of a loan with terms that are less favorable. So the real question is, what's the most that you think that you would need to spend? I might be able to get you up to 900,000, but if you're dead set not going over 600, there's no reason to pre-approve you at 900.
Right.
It's not even going to give you a good. It's not even going to give you a good picture so that you can make good decisions.
Okay. All right. So that first question then, or I guess two parts of that question: the maximum payment you're comfortable with, and then have you made a plan to fit this within your budget? Okay. What's the second or third question, I guess, Bill, that your lender should be asking you?
So the other question is, how long do you plan to live in the home?
Okay.
I think this is really important because a mortgage is the largest piece of debt that 99.99% of the public will ever owe money on, right? It's the biggest debt you'll ever take out. And the house is the biggest asset that you'll ever own. So with that in mind, we want to make sure that we understand the timeline, because the timeline is also going to affect the type of loan. Are we paying points? Are we buying down the rate? There's another question that comes on the back of that is, what do you think the market's going to look like? The interest rate market is going to look like in 12 months. And people are more informed than you would think. And a lot of times they'll say, I think rates are going to be high for a long time. Okay. One, you told me you're staying in this house for a long time. And two, you told me that rates are going to stay high for a long time. Then we might want to make a plan that plays into both of those factors. If you tell me that you're staying in the house for a long time and you think rates are coming down in 12 months, that's a very different plan that we're going to put together for the way that we structure your mortgage.
Okay, so that's a big piece of the puzzle, is determining how long you anticipate. And obviously life's going to change and you may end up a much longer period of time in that house or a shorter period of time. But having a game plan going in, I guess, can help you position them in the best spot for their mortgage, correct?
That's exactly right.
Okay. All right, one final question then. Again, we're going through questions your lender should be asking you when you're sitting down with them to go through that mortgage process. What's our last one here, Bill? What
are your financial goals? And will this new mortgage payment allow you to continue to achieve your financial picture as a whole? And what I mean by that is, the big one is, are we getting into a payment that's too high? Now we can't fund our 401k. Now we can't take advantage of the free money that our employer matches us with on the 401k, right? We don't want to miss out on that. Okay. Now I've talked to customers that's not part of their financial plan, and it's good for us to know that. Where I see an even bigger kind of divergence from goals is sometimes people say, I want to put as much money in the market as I can because I really believe that I can grow money at 8% in the S&P. I could be invested well in a conservative investment vehicle where there's not a lot of risk and still earn a decent percentage increase. Now, I find that to be true as well. But then they tell me they want a 10-year loan where the payment's going to be $800 higher per month, right? So there's a conflict in that thinking. The old school thinking was always pay the loan off as quick as you can. But I think there's more of a savvy financial culture that we're living in, and people are starting to think more about, I don't need to race to pay the house off. This was especially true when rates were at 3%, right? Why take 3% money and race to pay it off when you could put it in the market and earn 8, 9, 10%? So we want to make sure that everything is in alignment. The thinking is in alignment. If you really want to grow money in the stock market, we probably don't want a 10-year loan. We probably want a 30-year loan. We open up that excess cash flow every month, and then you could put that money in the market and grow the money there. So understanding the financial plan and how these things come together is really important.
Yeah, and even you mentioned 8%, but even somebody locked in 3% a year and a half ago, they could be making 4% just in a savings account at this point because of where things are now, and you'd be much better off. But I guess ultimately, though, what you're trying to get to is that full picture for somebody, right? It's not about just getting them into a mortgage and getting them as much money as they can get. It's about making sure that fits into a bigger financial picture for them, so that they're going to be comfortable and happy with the mortgage they end up in. You're
exactly right, and it, I can't say that any one strategy is right or wrong. It's more about what's right for you. Mm-hmm. So we want to learn, what are your goals? What are you trying to accomplish? If somebody says, I want to pay the mortgage off and I want to do it for these reasons, A, B, C, D, that makes a lot of sense. We need to look at maybe a 15-year or a 10-year loan. But a lot of people, they want to grow money in the stock market and they also want to pay the house off quickly. And quite frankly, there's just not enough disposable income to do both. That's where we have to make a decision, figure out what's more important. Maybe we take the 30-year and I'm expecting a pay raise in a couple of years, I'll hear. Great. Do the 30-year and you can always pay extra. Mm-hmm. You're in the driver's seat. So we want to help them understand what flexibilities they want to leave themselves open to by choosing a certain loan product.
And these questions come up, I'm sure I know you are asking your clients this, Bill, and people that come in to work with you, but is this something that's part of the initial conversation you have, that first 15-minute consultation you set up at Cross Country Mortgage, or is this something that maybe comes a little further down the line?
So we actually touch on these questions in the very beginning.
Okay.
And then as the process unfolds, we address them and provide solutions to help, create a loan structure that's going to solve those issues for the customer, for the borrower.
Outstanding. Well, if you want to start that mortgage consultation process, you can do so now by calling 484-352-4151. That's for Cross Country Mortgage. Or just log on, smartmortgageshow.com. You'll find a lot more information, some great resources and tools there for you as well. No matter where you are in that home buying process, if you're thinking about getting a mortgage soon, check out smartmortgageshow.com.
It's time for the Mortgage Mailbag.
I want to ask you a question, Bill, that I know comes up quite a bit, but it's something that came up recently that got asked to you, and I want to bring it to the show and answer it here for people. And this is one that I know that a lot of people have questions about, especially as rates go up and they're wondering, how much do I need to put down in order to get into a house? The common thinking, right, is I need to have 20% down, right? I don't need to think about buying a home until I can put 20% down. But there are other options that are out there, right? Is it financially wise to take those other options, or should you always be trying to target that 20% number?
I think the question is probably more appropriate asked by saying, or the statement is, here's the reasons why we don't want to put 20% down. There's a lot of arguments that support not putting 20% down. And so even if you have 20% to put down, a lot of people would, kind of going back to what we were just covering on investments, maybe you put 10% down. The rate's not going to be different. You pick up a small monthly increase in PMI, but that other 10% could be in the market working for you. So that's one reason why you might not want to put 20% down. But specific to your question, do we wait to put 20% down? And I think there's a lot of valid reasons why waiting to put 20% down might not be the right idea. And so first off, what if you wait to put 20% down and the interest rates go from 3% to 7%?
Mm-hmm. And we saw that.
We just saw that, right? We just saw that. So that would be a big reason to act now. And there's this old saying in real estate that says the best time to buy a house was 1 year ago. The second best time is right now. And in most cases, that holds true. If you wait and the rates go up, let's say you wait 2 years and the values go up 25%, which we just saw happen. So now you've waited to put 20% down, but now you paid 25% more on a $400,000 house. Now you've paid $500,000. You'd have been better off paying $400,000 at a 3% rate with 5% down than 7% with 20% down on a house that went up $100,000. Right? That's a much less favorable situation. So waiting to put 20% down is usually not the right answer. And here's the other piece. If you're really considering waiting, talk to your mortgage professional and ask them to run the numbers on 10% down versus 20% down. It might be enlightening and maybe a little bit deflating when you see that it really didn't save you a whole lot of money each month. And then if the mortgage professional increases the purchase price by 20% and takes into consideration a possible higher rate, it'll really come into focus how I'm not saying waiting is always the wrong answer, because sometimes there are reasons to wait for sure. But largely the people that are considering waiting, the reasons that they're considering waiting don't make sense when you work the math out on paper.
Yeah, that's a big part of it is actually looking at the numbers, right? And seeing kind of what that mortgage looks like at a 20% or 10% or whatever those options are to see if it fits in. And to your point, there's a lot of factors that go into it. It's not as simple as, 20% or no. You don't need 20% right now. It's let's figure out what's going to be best for you, and that's part of the process. So a good question that comes up quite a bit, I'm sure, Bill, for you, and when people are coming in to sit down with you for that consultation, that first 15-minute consultation, which you can always give Bill a call now over at Cross Country Mortgage and get that set up at 484-352-4151 or online at smartmortgageshow.com. But a great question, and one that we always encourage people to ask. If you have anything on your mind, we're going to go through some other questions like today with our questions asked lenders. We will do that a little bit later on as well in another episode. So please make sure you are subscribed to both the podcast and subscribe to us on YouTube as well. Bill, always appreciate your insight. And again, I encourage anyone with questions about mortgages or the process or anything that is on your mind to reach out to Bill, who's the regional president at Cross Country Mortgage, online at Smart Mortgage Show. Bill, have a good week, and we'll talk to you soon.
Thank you, Ben. Appreciate it.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Lend US, NMLS number 147060.